Hello, everyone. Welcome to our 80s, all 80s following sovereign finance AVC. Welcome, ecosystem actors. We're going to start our 30th AVC Subcommittee meeting. Yeah, we have, first of all, we have to mention we have two 80s following sovereign finance there. So shout out to them, Pipkin and Julia Chung. And I see they're already here. We have our 80s, Blue, Clocky, our AVC members. We have Marian, we have PV, Compared is also here. So Jack was also here. So thank you for being on time. We're going to start with, to my perspective, the most complex scope, which is the stability scope. For that reason, we have brought guests that have way more knowledge that can explain this specific topic, which is the PSM. And we're going to discuss, and not in that, I really hope, not in that technical way. But we find it relevant now with all the changes that are happening in that has been approved with Rune's proposal that was approved on Monday. And so let's start with that. Just want to make sure that both of our guests are in here. I see that already. Oh, Pablo is here, so I'm going to introduce him first. So Pablo is hey, it's the co-founder and core contributor for Angle Protocol. First of all, thank you so much for your time. Thank you for joining here. And so we're going to start. I think that the best first you could introduce yourself a bit, and also about the work that you've been doing, and maybe tell us a little bit about Angle Particle, and then we can really go deep into the topic for today.
Sure. So yeah, my name is Pablo, as you said, co-founder of Angle. Angle, we are a decentralized stablecoin protocol, like what Maker is, and we are focused on the euro. So our stablecoin, it's called AG Euro. It's the largest decentralized euro stablecoin. The euro stablecoin market is unfortunately not as big as the USD stablecoin market. We have approximately like 40 million in TVL at the moment. But the underlying infrastructure on which the stablecoin is built, it could work for Maker, and I'm glad to be here today to go over the different designs for stablecoin for PSMs, because it's a subject we have spent a lot of time on at Angle.
Thank you so much, Pablo, for your introduction. Just a reminder, please, everyone, mute your microphones so we can really listen to our guests. And please, I encourage you as well, if you have any questions for today's topic, you can let in the comments in the chat. I noticed that our second guest is also here, so I'm going to introduce him as well. We have Mr. Mrsisyphos, I think that's right, from Karpatkey, and I think that's the perfect timing. So can you please introduce yourself very briefly? Maybe also we have guests from Karpatkey, but maybe for new people, also explain us a bit what is what Karpatkey focus on, and then we're going to start with the questions. I'm gonna double check. Mr. Sisyphos or Sisyphos, can you hear me?
Yes, I can.
Okay. So, can you please introduce yourself, and then together with Pablo, we're gonna have you answer some questions.
Sure, yeah, of course. So I'm Mrsisyphos. I'm part of the Karpatkey organization, contributor to Karpatkey. Karpatkey is a team, a DAO that's contributing to treasury management and asset management with different DAOs. We have Gnosis, Balancer, CloudSwap, ENS, and a little bit of Lido and Aave. And I'm currently within Karpatkey focusing a lot of contributing and helping Aave to reach its mission.
Perfect. That was a very brief explanation. So just to give a brief, like a context, with every, I don't know if even our guests are probably they are more aware of us of what is happening in Maker, and we try to focus on the part of the modification on the cash stablecoins that are now there's going to be just USDP. We're going to go very deep that in later, but just if I really would like to know the audience insight on this specific issue. Do you think this is beneficial? You really don't think so? If we focus on the Rune's argument for this modification, it was like this was a short-term decision that he is aware of having just one cash stablecoin is not viable, and that he is looking for a solution for the long term. And actually, that's what we want to focus on here. Like we as this AVC are kind of like looking for solutions, but for that we also need more people that understand about this. This is also the rationale behind having to when I'm gonna call an expert to talk about this. So I have some questions in here, but of course we're gonna see also the chat to kind of like participate in here. Oh, hello there, Maxime. So the first question is, do you think a stablecoin can work without a peg, without a PSM? So I'm gonna go first with you, Pablo.
So I do think that a stablecoin can work without a PSM, but for me, you need a redemption mechanism in some way. A good example of stablecoin that works super well without a PSM is that of liquidity. When you own LUSD, you can redeem some vaults, like against collateral held in some vaults. This may be bad for the UX in the sense that if you're the lowest collateralized vault on liquidity, people may just like redeem on liquidity, they call it Trove, and get your ETH back. But it's a way to contract the supply in case where people want to burn the stablecoin. The issue we're seeing with protocols which do not have a PSM, and one example is that of Libra, which is a CDP only protocol, is that getting a stablecoin at peg when you don't have a PSM, like when you're a CDP system, it relies on indirect arbitrages. Like people, oh, I'm going to repay my debt for less than $1, even though it costed me $1 to get the debt.
Sure, I don't think I got the question though. Would you mind rephrasing it?
Sure. Yeah. Let's talk about the disadvantages of Maker's PSM and how you would what would you do in order to solve this? What we should take into
Sure.
account?
Well, I think really Maker PSM design was very innovative and actually effective for when it was deployed. And this community probably knows. And it's certainly more educated than me on the PSM and where some of the challenges that it faced in the recent times. But I think that some of the events that may have that proven that there could be new iterations um, that can solve some of these challenges, right? And I think this is some of the reasoning behind some of the features, sorry, that the Go stability module that's being worked out has. Like one clear example of that would be that I think PSM when it was implemented, they didn't have a clear way of like capturing some of the value of the peg mechanism it was enabling, right? Or the arbitrage that it was kind of originating. And that's one of them. I think the other one, and again, I think we were going to talk a bit more, but there's going to be time to talk a little bit more about the PSM later on, right? But I think another aspect of the PSM that probably deserves some thinking and that's we're going to take into account in future iterations is the capacity to either put boundaries, whether that's for price action, or what have you, that will enable or disable the PSM, right? To maybe put a boundary on the impact that events like the one for the SVB bank could have, right? And not only in DAI, but the whole ecosystem.
But thank you. I'm just want to mention something. Please do not limit yourself when you're explaining. We seriously believe that this is very relevant that we should be discussing. And since not everyone, it's very technical, since not everyone is an expert, like this is the opportunity that we are also learning more. And so just to point that out, that you can I'm not asking for anyone to be brief, only the introduction, but now yes, you can talk as much as you want. So now I'm gonna go with the same question. I'm going to repeat again about the disadvantages makers PSM. So Pablo, what do you think about this?
So I have thought a lot about this one. I think Sisyphos answered quite well on the fact that the issue with maker system is that there are bonds in like what can be minted with one asset. Like you can limit how much is minted of DAI with USDC on a given day, how much is minted on with USDP, but these are not relative bonds. So for instance, like the maker governance has to be manually updating the bonds, and it doesn't like smoothly adapt as the system grows. So it's like an edge remark, an edge disadvantage, but still one. The big disadvantage for me is that you do not get a claim. I mean, there are several of them. First, when you own a DAI, you do not get a claim on the basket of assets which are making up the PSM, which means that when I own DAI, I don't have a claim on the reward asset. So maybe putting reward asset on the side, I don't like one DAI doesn't give me like 0.6 USDC, 0.4 USDP, for instance, depending on the composition. Why is it a problem? Because if things go wrong, if one of the assets in the system depegs, then what people are going to do, they are going to like swap all their, like let's take the USDC depeg example, swap all their USDC towards DAI and then swap that DAI towards GUSD, which means that maker, which is supposed to be diversifying its reserves, or not if you want to go all in USDP, but well, you should be diversifying your reserves. You end up only with a weak asset which is depegging. And if you have like the automated scenarios, and it goes within the bond idea of Sisyphos, but like price bonds here, in the sense that if you have automatic blocking features that prevent people from, or that deter people from swapping, for minting DAI with USDC when USDC is depegging, or for burning DAI for USDP when other assets are depegging, then you are making your users far better off, and the system is far more predictable in case of a black swan event, because black swan events will happen. Like you shouldn't build a system like a PSM without taking into account the fact that shit will hit the fan at some point, and you need to have like this fallback system. So there are no fallback systems, there are no redemption features, and there are like manual limits. These are my main reproaches for DAI price stability module. The ways to solve this, like this is how we have built the Angle price stability module with like trying to improve about these flows. There are some you are losing on some aspects when you try to make it all weather when it comes to how am I going to be resilient to a USDC depeg situation. For instance, Angle price stability module is slightly more gas expensive, and it scales the cost scale linearly with the amount of assets which are supported in the backing. But you get a guarantee when you hold an AG euro, Angle euro stablecoin, that you are really owning a basket of assets, like of euro stablecoins or of euro assets, and not that you don't have a claim on the weakest of all the assets, which is for me the case when you own a DAI. When you own a DAI, you hold the weakest of all the assets in the price stability module. So it's here we are not talking about very weak assets. It's like USDC, USDP, GUSD. So it's fine, but you never know.
Yeah, and I think that related some of what Pablo is saying. Depending on your perspective, that you could think one of the other challenges the PSM has is if like all the USDC is gone, right? And you want this to still be active right now with the current configuration. And one of the things that you'll need to that the maker community will need to think about is how like getting one of the real world assets that's part of the collaterals and maybe regain USDC to maybe swap it for another PSM coin or replenish some of the modules USDC, right? And that could be a slow process. And there's a window of time there where PSM would be maybe not usable, or there could be other risks. So that could be I guess another challenge with the PSM.
Yeah. I think that, of course, it's important to make the PSM. No, sorry. It's important if PSMs are like, it's not a problem if these are not usable from time to time because like something is going wrong with one of the assets and you want some clarity. I believe that redemptions feature enabling users to get a claim on the basket of collateral and still go out if they want to go out or take their loss. It's important to enable this at any point in time, if possible, because this is what you don't want. If something goes wrong, you don't want your users to be blocked. Like DeFi protocols, they should, for me, leave the ability to leave at any time. And it's not a good UX to have people locked in at some point because some collateral deviates. If people want to leave, then it's fine, but let's give them a fair share of their ownership on the collateral. And this is, for me, the way to implement like the real vision of what a decentralized stablecoin should be. Like a decentralized stablecoin, it's a liability for the sake of the protocol that should give you a claim on the assets, and the assets here are the collateral. And by having a redemption feature on the PSM, you kind of make this vision true and guarantee the fact it's like bankruptcy remoteness implemented at the core of the protocol.
I was waiting if anybody else wanted to say something else. Okay, I'm like here literally like taking notes of what you guys are saying so I can keep up with what you everything that you're saying. And so, okay, we have mentioned, you have literally point out the challenges with makers' current situation with the PSM. And so now let's compare it, or not comparing, but let's get to know more about the design of each of your PSM. We find it interesting to know what is it like. And so we're gonna go one by one. So yeah, Pablo, you first. If you can tell us about your own model of PSM, like your PSM design.
Sure. So like basically Angle Transmuter was built to improve over, so it's called the Transmuter Angle PSM. It was built to improve over the flows we were seeing in Maker. Basically, so it's a PSM like Maker when everything goes well, which means when stablecoins are trading at peg, like you can mint AG euro with €1 worth of stablecoin at any time. You can burn one AG euro with against €1 worth of collateral at any time. If one stablecoin in the backing is depegging, the mint price differs from the burn price. Like the protocol will buy the stablecoin at the lowest value possible. So if, for instance, USD, or like in the case of that, if USDC is worth 1.01 because dollar, well, the protocol would still buy, would still consider a mean price of $1. But it would consider a burn price of $1.01. And if there is one stablecoin in the backing which is depegging, like if USDC starts to be worth, I don't know, 99 cents, well, the protocol is no longer buying USDC, like it's blocked, or you need to buy for like 1 divided by 0.99 worth of USDC. And like you won't be able to burn, like the protocol will apply a penalty on burns for all the other collateral assets of the protocol equal to the deviation of the USDC price with respect to its peg. This means that if USDC trades at like 90 cents, we will apply a 10% deviation penalty to all the people trying to burn their AG euro for other stablecoins in the backing, like in the PSM. This is a way to deter people from doing the trade, like USDC to DAI to GUSD, which was obvious during the USDC depeg situation. So this is one thing. The other thing is that the protocol implements a claim feature, a redemption feature. Like you can burn your stablecoin, which means getting with your AG euro one of the collateral assets that are in the backing, but you can also redeem your AG euro. This is how we call it, which means getting a portion of all the assets that are in the backing. So if in the backing there are like 60% USDC, 40% USDP, then with one DAI, in this case, you would get 0.6 USDC, 0.4 USDP. And it's a way to ensure a fair redemption, a fair redistribution of the proceeds of the protocol if there is an under collateralization scenario. If the protocol loses something, you can still redeem your AG, your DAI at the fair value of the backing without needing for a governance to take some decision, and without creating like unnecessary arbitrage on what's going to be the fair outcome of what governance is going to implement. So these are like one of the main features. And one other feature that I can mention is that the protocol comes with dynamic limits on each collateral. So the fees are dynamic based on the exposures the protocol has to its assets in the backing. Like USDC, the protocol may say, I don't want to hold more than 70% of USDC in the backing. And then so the system will prevent people from minting DAI with USDC if the mint leads to more than 70% in exposure. And this way, you can set a system which dynamically incentivizes market makers or traders or just anyone looking to buy DAI to set the system in a state where the exposures of the assets of the protocol to its underlyings has been thought in advance, and you don't need to manually rebalance the reserves. It's the market that is rebalancing for you, so it's a lower cost and also a more trustless experience whatsoever. And that scales with the amount of stablecoins. So it works with 1 million, 1 billion, 10 billion in assets under management, and you, at no point in time you need the governance to intervene for this rebalancing, provided that you don't use like too exotic assets.
I'm gonna go now with you, Mr. Saif. But first, just to point it out that then the following question is gonna be related to, okay, and can we? I don't know if the word is implemented, but can we also have something similar to your models implemented here with the Maker PSM?
Yes.
So just
Yes,
to
you can.
point it out.
You can. That's the point, you know, like it's generalizable, and Maker could like use the code, it's been audited, and implement the same for Maker, and I think it would be beneficial for the whole Maker ecosystem. I mean, like it would leave DAI better off, but it's not the only design that is built on this. Like Gyroscope, another USD stablecoin uses like we use similar ideas. And I guess it's going to be the same for Avego, but I let Mrsisyphos iterate on this one.
Thanks, Paulo. So yeah, there's probably a lot of things that are in common. So the GSM is really the PEG stability mechanism. It is inspired by MakerDAO's PSM design to exchange, Go with other tokens at a preset ratio. I think or at least I find its design, it's kind of special because it includes some configurable functionalities such as modular price and fee strategies, which I think resemble a little bit what Paulo was mentioning, that kind of help influence and determine the conversion behaviors of these assets, right? As well as I think it's a variety of safety oriented functionalities, such as the ability to freeze swaps and based on external or market conditions. So if I were to kind of touch base on what some of these are, like if I would start with the price strategies, it allows it gives the ability, to the DAO to adjust the pricing ratio between Go and these other stablecoins. So the easiest way to think about it is you can have a strategy that's a fixed flat ratio between, let's say, Go and USDC, like 1-to-1, but it can be dynamic based on price oracles, market. It can have bonding curves, like the one I think Paulo was also describing, stable swap curves, etc. So right now, there's actually an AAP to deploy the first two GSM modules that are going to be with USDC and USDT, and both of them have the price strategy of 1-to-1 between Go and these other stablecoins, right? But it is flexible from that regards. Which, by the way, I don't think I've mentioned this, but these GSM modules are but another facilitators, right? Which facilitators are the smart contracts controlled by the DAO that are allowed to mint and burn Go, right? And the other functionality is the fee strategies. So the GSMs embedded with the capacity to have, again, dynamic or fixed strategies for the fees. And in this case, it's going to be a flat fixed fee, but it can be dynamic. I think that's important because going back to some of the comments that I mentioned before, a fee strategy also allows the DAO to have the conversation of how much it can participate in capturing the value from the arbitrage and from the pegging mechanism. But similar to the price strategy, it can help influence the market behavior, right? And maybe make it easier to go to the peg, but harder to go off the peg, kind of thing, right? It has as well exposure caps, like the ones that was being described for Angle, meaning that there is a cap or a limit to the exposure that the module can have to the exogenous or to the other stablecoins, right? It imposes that cap, and so if you want to mint more gold backed by that stablecoin, or you wouldn't be able to. I think right now, if I don't remember wrong, the parameters for that are in the on-chain vote right now are 500,000 cap for each USDC and USDT, and then the last two that I think this set that I've described are actually for the peg mechanism itself, but the other two are a bit different. The other one is a last resource liquidation, which is a feature that allows the DAO for kind of worst case scenarios to regain control post the GSM and even liquidate the exogenous assets. So that would be in this case USDC or USDT. And there's also kind of the capacity for the underlyings to actually be LC 4626, like the STI, with the embedded capacity for the DAO to capture some of the yield, right, of these underlying assets. Again, the first two are going to be USDC and USDT, so not necessarily, this feature is not being, I guess, leveraged right now, right away. But still, I still find it interesting that it has that capacity. Like I was saying, in the discussions that happened, in the last 2 or 3 months, there was a lot of back and forth in terms of which should be the settings, the parameters of these two first GSMs that are being implemented. And there was a lot of recommendations coming from the AVE risk management service providers. And some of the parameters that have been chosen by the community and snapshot votes were a 0.2% of fees. So again, like I was mentioning before, flat strategy for the fees settled in 0.2%. And then the boundaries, which I again found interesting, and it goes back to the comments that we were making about some of the challenges that the PSM faced. There are two different set of boundaries: one to freeze the modules and one to unfreeze them. Right. So this information is already embedded in the smart contracts, and in this case, is when the underlying assets go above 1.01, so that's how 100% BPS, or below 0.99, which is minus 100 BPS, that's when the module will be frozen, right? So at that point, GSM will stop working. And then there are unfreeze ranges, which they have to be kind of a subset of the freeze range, where the modules will unfreeze once the price of the underlying reach parity is 0.995 or 1.005. So that's 50 VPS to each side, right? I think I mentioned them already, but the caps, the exposure caps are going to be 500,000 each for USDC and USDT. That's kind of 1 million in total. But there are ongoing discussions with intent to grow that exposure, right? So this is a small amount. The intent is to make it larger and larger, which I think will probably be a joint effort with increasing the overall Go minting cap, right, and the overall Go supply. I don't know if it was clear or is any follow-up question on that.
I want to ask that also for the audience, if there is anything that has not to be clear enough of what you are already training. I encourage to ask now. I think this is, as I always mention, having the speakers here is the perfect moment to learn more and ask about the doubts. But I think, I don't know if I don't want to cut you with the next part, because both of you actually have mentioned about, of course, the go the peg situation. So we're gonna focus on that. Is it really fixed, that situation? And can you tell us what have you learned from that? I don't know if you should call it mistake, is something that happens, but yeah, what could you tell us about it? Who wants to go first? Maybe Paulo?
I'm sorry, can you please repeat the question?
Yes, about the peg, the go the peg situation, the mistake you have learned from it.
So for me, there was no real mistake. Like it was foreseeable. It could have held with like more liquidity to absorb go sales. I think it's more a good example that if you launch a stablecoin without a proper price stability mechanism, a CDP stablecoin without a proper price stability mechanism or a redemption feature, well, you can expect this transitory depeg, but doesn't mean that like the stablecoin is bad per se, like because people tend to misinterpret and to consider that, oh, the stablecoin has depegged, it must have been hacked, or it's a really bad asset to use. Here, like for me, my conception and how I perceive Go hasn't changed with the evolution of the price and the fundamentals of it. It's just that it should have been launched with a CDP with a redemption feature, and that's it. But it doesn't mean that the protocol was that you would lose money by like putting money into it, basically.
You can give us also more light into this, because as far as I'm concerned, Karpatkey is working with AVE. Is that right, Mr. Mrsisyphos?
Yeah, that's right. Yeah, there was a proposal that passed not so long ago. But yeah, we are definitely contributing with Aave. And I think there are several things to highlight from this business case of Go being underpeg almost after it was created, right? I think it was a very short moment where it was a peg and then went down. I think one of the challenges it had initially was that the borrowing rate for Go was actually very low. So that created a really easy arbitrage opportunity for rates, right? If I'm not mistaken, if I remember wrong, the initial borrowing rate was about 1.5 or something like that percent. So you can easily imagine that it was easier to arbitrage almost any other stablecoin rate that's out there. And you can think about SDI, for instance, right? So I think that generated a lot of selling pressure. That together with the fact that it was a very new stablecoin, not so many integrations, and hence not so many probably use cases at that point. So yeah, that kind of generated the DPEG. The liquidity profile, I think, wasn't that great at the beginning as well. I think that's something that Paulo was making a reference to. There wasn't much liquidity to kind of absorb that selling pressure. But I think at the end of the day, with those rate arbitrages opportunities, I think that was deemed to happen. The since then there were, I think we could think about that as three different type of efforts or tracks. On one side there were several intents, or several, actually it wasn't intent actually that happened. There were several instances where the rates were increased to kind of get it closer to the rest of the market. There is an intent to, I think, having a bit lower than the rest of it, but they were increasing it, trying to get it closer to what the rest of the market is. Mind you that there's something I didn't mention before, but uh, there is a possibility to have an even better rate, to have a discount on the rate if the user has staked Aave, right? So you can stake Aave in safety module, and then you would be able to get a discount on a borrowing rate. And there are certain like tranches, right? Depending on how much stake or you have, it depends how much of a discount you'll get. But I think at the end of the day, with an already lowered an interest rate that was lower than the market, and a lot of, I guess, people that was already part of the Aave ecosystem and probably already had stake Aave, sorry, that even got an even lower borrowing rate, that probably made the arbitrage opportunity even larger. So going back to what I was heading, there were several instances where the interest rate was increased, but at the end of the day, this still is a manual process, right? The borrowing rate is a fixed rate in the sense that it doesn't change with utilization. It does change obviously when the DAO decides to, but it's stable from that regards. And there's an opportunity, I think, to revisit having a fixed rate and finding ways to have this borrowing rate kind of somehow dependent on the market. So that would be a good change, and I believe Aave is looking into that. Then there's there was another track, I guess, of efforts. There was better engineering the liquidity profile that's in the market, and there was a large effort to do that with Maverick. I think to some extent that may have helped, but it wasn't able to recover the peg doing that per se. Of course, every time you create a utility that demands of the token and create some buying pressure, that will definitely help recover the peg. But at the end of the day, on its own, it wasn't able to do the trick. And one of the things that had the most impact, and today was actually a very important day from that regards, because actually that got implemented and pushed the price up. There was the discussion to add the Go to the safety module through the state Go kind of option functionality. And all that times that was being discussed in the forum, back in December, I think it was, and this last week where there was the on-chain vote and it was implemented yesterday, and you can see how that influenced the price action, right? And that's, I think, because the expected amount of incentives that would be allocated to the safety module compared to the supply of gold that's out there, that proved to be significant enough that created a good buying pressure that pulled the price up. I think to some of Paolo's comments, these are some of the aspects that I think made it a challenge for gold to keep the peg or maintain the peg and cause that to lose. Now, these things that I've said talked about are not necessarily part of the core, I guess, design of Go, but they're part of the ecosystem and satellite, right? Like Stakeco. So I think things like that will definitely help it recover the peg. But when the cap is increased and we enable more co-supply to be borrowed, I think that's where we will see what new challenges may present themselves, and whether some of the solutions that or some of the tools that the community have found helpful this far will still remain helpful once the supply is increased, right? Because there's going to be so much that you can go with other incentives for the safety module, right? So I think it's it has proved to be a great help right now. But I can't wait, and I'm excited to see what's going to happen once we increase the supply and find more utility cases for the token.
Well, thank both of you for your perspective. I have a lot of comments to what you've been saying. First of all, about what you probably mentioned about this not really being a mistake, and it's really good that you clarify it. I think that now that you have explained it, it's more like well, what's a synonym for mistake, but things that don't go as planned and not only work for one specific protocol. For example, this is a very huge example, is like now protocols such as Maker, such as the one that you're working with, can also, just like you mentioned right now, that what you should take into account and the reason that happens and what we should have done, and things like that. I think that these are the perfect situations that you see that, or you notice that one protocol success, it's not just one protocol success, it's the whole blockchain ecosystem success. And when let's not call it failure, but when things don't go as planned, well, it could benefit also a lot of protocols, because everyone learns from that situation. I'm not gonna say mistake anymore. Okay, so that was one. And then, well, let's not forget that Go is not at all, actually, even Aave per se, it's not at all. So yes, now having said that, and the situations that you have already mentioned in order to maintain in the peg, let's go now to the next topic, which I think yeah, Mr. Mrsisyphos, I think you have already mentioned about the stake model of Go. If you can tell us how it will work and what stage of development it is.
Good. Yeah, I can share a few words about that. So Aave, has to cover for bad debt and in shortfall scenarios. They have implemented this safety module where users are incentivized to lock their assets, and if there's a shortfall event, then after governance discussion or a governance exercise, there could be a decision to cover that shortfall, that bad debt, with funds from the safety module, right? And you can think about safety module as really a set of different modules. Where this far, you may have heard of Aave or no, sorry, Stake Aave or the Aave ETH PPT, right, from Balancer. The whole stake Go discussion really was to add Go as another module to the safety module, if you will. So that's really what it is. It is users locking Go, getting incentives for it, getting incentivized for locking it there, with the understanding that there is a risk that the the DAO may decide to actually use that Go to cover for shortfalls. It has been actually implemented already. It was, if I'm not mistaken, the smart contracts and everything was deployed yesterday, but the UI, I think, went up in the UI, it appeared in the UI today. And again, if you look at any price chart for Go, you'll see that it has spiked, and since then the price has lowered a little bit. But you can see the influence that has had in the market, in Go market. And I guess in terms of parameters or how that looks like for Stako, these like I was saying, these assets are locked for be used to cover a shortfall, and that means that there are two parameters I think which are important if anybody's thinking about doing that, which is the cooldown and the percentage of potential slashing, right? So those two parameters for Stako module are 20 days for the cooldown, meaning that if you lock Go in order to unstake it or unlock it, you have to wait 20 days. And then the slashing, the maximum amount of possible slashing is 100%, right? Which is different from the Aave, stake Aave, which is I think 30%, if I'm not mistaken. So that means that if there is an event that the DAO decides to cover for, it is possible. That doesn't mean it's gonna be for sure 100%, but it's possible that the DAO decides to, cover by slashing that module with 100%. That slashing, it's socialized with all of the people that have locked Go, meaning losses are going to be proportional. But yeah, that's kind of how it works. I don't know if I try to also give a general description of what the safety module is, I guess. But let me know if that wasn't clear.
That was perfect. That was good. Now, the last question that I have, before the last one, it's for Pablo, and if you could tell us about the products by Angle, which are STUR, which is the very wanted one, and also AGUR, and like how was this implemented and the most relevant aspects of them.
Sure. So like AG Euro, it's Angle Euro stablecoin, works really similarly as Maker, except like for slight differences in our price stability module, like that I've already mentioned, or for differences in our CDP infrastructure. Like it differs from Maker vaults. And all of this contributes to making a Giro. And another difference is that and that powers a Giro is that our CDP infrastructure is live on different chains. Like AGRO it's a cross-chain stablecoin by Essence, and so we this is how it works, and the protocol generates earns yield on its reserves from people borrowing the stablecoin and from tokenized securities held by the protocol in its reserve, just like Maker has its real world assets infrastructure. Well, Angle has its real world asset infrastructure as well that is based on tokenizers. It also works differently from Bakkt. Well, we earn a yield on our assets, and a portion of this yield is automatically allocated to H0 holders, just like a portion of the yield generated by the DAI ecosystem is allocated to SDAI holders. Well, the same goes for ST Euro holders, which are people owning staked H0. And these people are earning a yield which is currently at par with the risk-free euro, I mean the base yields from the eurozone. So this is for your ST Euro, and you could look into it as like an internet bond or a form of wrapper built on top of money market funds, in the sense that you can get in, get out whenever you want. You don't have to face like a redemption period. You don't have to face bank holidays or weekends before you can exit. But and you have a full transparency on where the yield is coming from, how the protocol is backed, and the fact that this is fully sustainable as well for the protocol to offer this yield.
Well, thank you so much. Now, the last question is that we have already know more about your work, about your experience, about your insights on the maker situation. So, having mentioned also earlier about the now maker has only USDP as a stable cash, what would be like the most viable solution in the short term or in the long term to I think we all know that having just one stablecoin, it's not viable. So, uh, you have given light on this aspect, but let's be like, I don't know if the word's realistic, but with the situation in the current situation in Maker, what would be like the possible solution to it's kind of like risky to have one stablecoin, cash stablecoin. So,
Yeah,
what would you
but
do in this situation?
so for me, it's better to have one stablecoin than to have multiple stablecoins and no mechanism to protect against the depeg of one of the stablecoins in reserves. So it's either you keep one stablecoin, and I would put in the price stability module as well. I would try to bring your real world asset infrastructure back on chain, even though it's complex. But so like authenticated users could get a claim on this, and you don't have to trust arrangers, because this is also a form of price stability module. And yeah, we'd rely on multiple stablecoins, but with good diversification mechanism. So a revamped price stability module.
Oh, thank you so much, Pablo. I was actually writing it down, but this is just a reminder that this is also being recorded, and these are very well, not that technical right now because they're explaining it, but still it's a little bit hard to process if you're not yeah, I don't know, an expert in these topics. So that will be all. I don't know if you guys would like to just say one last thing before we finish this.
No, thanks, Susan. Thanks for the invitation, and the rest of the guys for joining and giving us the space, I guess, to share some of the things that we are doing, or things that we are collaborating with in the space.
Same. Glad to have been invited today. Thanks, guys, for having us, and happy to answer any question you might have, like synchronously, or like help maker governance along the way. Propose like improve, like make the ecosystem converge towards better solutions overall.
I'm glad you said that because actually we are going to reach out probably because this is what we want to work on this specific part. In that, now that you have also pointed that out, that we can actually reach out. Yes, you will definitely hear from us. And no, thank you guys. And I'm not gonna let you take more of your time. So that will be all of this part. And I cannot believe that it has already happened an hour. And this, as I mentioned before, this has been a lot of very technical stuff. So we're gonna stop in here. But just a reminder, please, that we are working on our guide of security journey, which is the capture experience, which is we are collecting data from 80s. I'm going to share our document. But right now there is no call from ecosystem because this was very, very, very deep, at least for me. So that will be all, guys, and we are going to see next Thursday. Thank you so much. Bye bye.
Thank you. Bye.